This is the largest wealth transfer in human history, and it's happening now. The system has only been allowed to come down twice in the last 110 years. I have come to perhaps obvious conclusion that accelerating GDP growth is essential. Gold and Bitcoin are going to rise against it. So that money in those superannuations, that money in the treasury, that money in those pension funds is going to melt. Elon Musk has now stepped down from Doge, gone back to work on Tesla and to create robots, because we're not going to have the demographic boom that we need. And so the only way to grow out of this mess is going to be with robots. The main asset within superannuation and pension funds is bonds and stocks. They're the things that are going to need to be stolen from or sold down. Gold and Bitcoin isn't currently in superannuation funds, and relative to these other things, stocks, property and bonds, it only has a small percentage of global wealth allocated to it because all right, let's go. It was a Lyn Alden speech. It was about 19 minutes at the Bitcoin conference, and she basically explained the thesis for nothing stops this train. Nothing stops this train. You might have heard me speak about that in the past as well, just in relation to the debt in the system, the amount of debt that the Federal Reserve, central banks and the governments have started printing and won't be stopping, and the amount of debasement. And she makes the most clear and concise argument that I've seen in a brief 19-minute video. It's amazing. So I recommend that everyone watch the 19-minute video in its entirety. I'll link it in the description, but I'm also going to be breaking down that 19-minute video and how it's important to us as investors and some of the subtle differences between Australia and America's position. I'm also going to be going through some charts from another research service that I subscribe to, Luke Groman, and it kind of backs up the same thing. Just a couple of updates. So some of you might have seen me talk about my GameStop position. Just letting you know, with relation to my GameStop position, I have reduced that in size again. The position is down to, say, 6% of my portfolio. I'm considering closing that out completely. Basically, GameStop announced that they were putting Bitcoin on their treasury. They had about 6.5 billion in cash, 1.5 billion that they raised through a debt offering, and they only purchased $500 million worth of Bitcoin. And I think they waited till it was about $100,000 to buy the Bitcoin. So look, all in all, I'm not sure that they've gone as hard as they could have. The story still might unfold. It's a stock that has animal spirits, and it's a stock that has like a life of its own. So my position's still there a little bit, but look, my thesis on that has largely changed. I'm not sure that it can do the 10x like I thought it could, so I'm bringing that position down. For what it's worth, my largest option position at the moment is MSTR, but I'm actively trading in and out of that position, so I'll be reducing and increasing that position depending on the movements in price. In relation to my Tesla trade, that was, I think, the second episode, so that Tesla trade is still open, and it is currently up 261%. So it's come back a little bit, but it's still up 261%. I did open another Tesla trade. I'm down about 6.6% on that trade at the moment. I'm considering whether now is a good time to leave it open or to cut that position and then re-add lower. We'll see. I'll keep you guys updated with that one as well. Thank you guys who commented in relation to the 10K trading challenge. There was quite a lot of you who commented that you'd want to see that and you want to be involved in watching that as it unfolds live. So here's what I'm going to do. Listen carefully. Make sure that you tune in next week, because next week I'm going to give a link, details of a link on where you can subscribe for updates on that 10K trading challenge. So I know that sometimes you won't watch these videos straight away, and I know that if I put out live updates, even if they're 2-minute video updates on YouTube, you might not get to them all straight away. So in order to keep you guys best updated with how I'm treating that $10,000 and how I'm trading that $10,000, I think the best way is going to be after I've made those trades, to put email updates out to those of you who subscribe. So watch next week and I'll give instructions on how to subscribe to the 10K trading challenge. Feel free to join along at home with me and share your results in the comments. As always, it's not trading advice. I'm just showing you what I'm doing, and hopefully that can give you signals on how I'm seeing the market at that period of time. All right, so let's get into it. Let's get into the Lyn Alden podcast that I stored during the week. It was from the Bitcoin conference in Vegas. It was incredible. It was an amazing 19 or 18 minutes of macro alpha. But let's go through it. I'm gonna show you certain parts of it, and then we'll stop the video and we'll discuss what that means for us. But yeah, let's jump into it. All right.
Over the past several years, I popularized the term "nothing stops this train," and of course, that originally comes from the show Breaking Bad. And for those that have not seen it, it's about a chemistry teacher who gets diagnosed with cancer and ends up going to the dark path of cooking drugs in order to pay for his own treatment and to support his family. But of course, the moral arc of the story is that he eventually cannot stop. Even when he's past his cancer, he can no longer stop doing what he's doing. And by the 5th season of the show, his colleagues are telling him, we really have to slow down, we're getting over our skis here. And he says, no, nothing stops this train.
It's quite fitting, right, that this guy had cancer, because the cancer analogy pretty much applies to the destroying of our purchasing power. So the government spending, the public rising of the public debt, and the dollar debasement is a cancer. It's a cancer on our purchasing power, the unit of currency that we collect for our time and energy invested in our 9-to-5 jobs, in our businesses, etc. So yeah, the analogy is quite striking. Let's continue it.
And I've been using that term to describe what's going on with US fiscal deficits. And I'll go into, during this pretty concise presentation, what that means, why it matters, and why it's so unstoppable. Because of course, we're here at a Bitcoin conference, but there is this much larger dollar system that's happening around us and all over the place. And so the inter-exchange between what's going on in Bitcoin and what's going on in dollar land really matters for things like the exchange rate, things for the economy, investing in general. And so we'll start now. We'll go into these kind of pretty concise slides. Some of them will be simple slides, some of them will be a little bit more complex, but I'll walk you through the parts that really matter. So this chart here shows 2 lines. One is the unemployment rate, and one is federal deficits as a percentage of GDP. And this goes back many decades. And as you can see from the slides, there's always been very good correlation between them. During recessions, unemployment goes up, the federal deficits go up, and during better times, unemployment is low and federal deficits are low. The one brief exception, if you can kind of squint and see it on the chart, is 1960s. That's when we had the Vietnam War. So there's a little bit of an exception, but other than that, these are almost the same line. But what you'll see on the right-hand side of the chart, and I circled it in green, is over the past several years, ever since around 2017, we've had a decoupling. We've had shrinking unemployment, we've had low unemployment levels, and yet the deficit has blown out to 6 or 7%. Even before and after the pandemic, this was already happening. Obviously, it went into overdrive during the pandemic, but we're kind of in this new world now. I'm not the first person to talk about the deficits, but I am trying to bring attention to what's going on now that was not going on for many decades. We're entering kind of a new era. So that's what the deficit is.
What usually happens is, as the unemployment rate rises, the fiscal spending increases to kind of help get the economy through the recessionary periods and to help bring the unemployment rate down. A phenomenon that we've started to experience, though, or the US has started to experience, is the unemployment rate has stayed at record lows, but the fiscal deficit continues to rise. And Lyn will explain exactly why that's happening as we go throughout the presentation, but it is a dangerous cocktail Because what it basically says is, hey, the unemployment rate is low, fiscal deficit is high, it doesn't really give much room if something was to cause the unemployment rate to spike. Now, with relation to the unemployment rate, there's various theories as to why it could be low and why it's still low. One of the theories that I have is the gig economy. So previously, if you lost your 9-to-5 job, it was very hard to replace that quickly, and you would have to go on a dole queue or a welfare queue in order to collect benefits. Now, some people are leaving their 9-to-5 job and going and driving Uber, or being freelance graphic designers online, or freelance anything in the digital space online. So I think that unemployment rate has stayed much lower, and we might not experience recessions the way we used to experience recessions, where the unemployment rate spikes because everyone gets laid off, because everyone has that ability now to transition into the gig economy. So that's something that's interesting.
So this chart shows in the gold line is the price of gold, and the dark line, the black line, is real interest rates. And again, we've historically seen that there's been a very strong correlation between these two things. And so for those that don't know what I mean by real interest rates, this one is specifically the 10-year Treasury yield minus CPI inflation. And the reason these two charts, gold and real Treasury rates, are so worth comparing is because they're the two primary reserve assets globally. They're the ones that compete with each other at that scale. And gold, of course, is pretty scarce. The supply grows by an estimated 1% to 2% per year, but you don't get paid any yield to own it. If anything, you incur an expense for storing it. Whereas Treasury yields, dollars and treasuries, they grow at a much faster supply growth, but then you get paid this yield to own them. And during periods where the yield is rather high compared to measured levels of inflation, some of the investors that might otherwise buy gold get enticed to come back to the dollar and the Treasury system. But then during periods of time where the yields are not high enough compared to inflation, many investors flock to gold. They basically say, if I'm not going to get paid anything on my treasuries, why would I own treasuries that are way more abundant than gold? And historically, this has been a very strong correlation. High real rates means higher gold price.
So what she means by these being the two primary reserve assets is where wealthy sovereigns or individuals, corporations, where they park their money when they need it to be accessible. The largest two places where central banks, sovereigns, big financial institutions park their money is gold and 10-year yield, the US 10-year yield. And she'll explain a little bit more about the divergence here and what conditions normally lead to people putting more money in the bonds, the 10-year treasury, versus putting more money in gold.
And on this chart, the real rate is inverted. So lower means higher real rates. And again, as you've seen over the past several years, this one in particular starting around 2022, we've had a complete decoupling in the price of gold and real rates. There's something new is happening here in this kind of fiscally dominant environment. And of course, this is relevant for Bitcoin. A lot of people, if you would have said 5 years ago, if interest rates are 4 or 5%, would Bitcoin be selling out massive conferences in Las Vegas, and would it be worth over $100,000 per coin? Most people would say no. In fact, many critics kept saying that it's just a zero-rate phenomenon. It's some bubble that's going to go away as soon as the Fed gets any sort of hawkish in them.
So what she's basically saying here is, as real rates rise, normally the price of gold comes down because people move their money from gold into treasuries to take advantage of the yield and to ride any appreciation if that yield was to drop. But what happened in 2022, and we'll explain why very soon, is the real rates rose, but instead of people piling into US treasuries, they started piling into gold. So this is a very significant change in the macro regime, and we'll explain this in more detail throughout the podcast.
So these charts are a little bit noisier, but I'll direct you to the parts that matter, because this is the inflection point that really shows up. So the blue line on these charts is private sector year-over-year debt growth. So that's bank loans and that's corporate bonds, that type of thing. The red line is federal debt growth. So you have private markets and public markets. The pane on the left is 1955 to 1990, and the pane on the right is 1990 to the present. So this is a 70-year history. And if you look at the left side, for the most part, the blue line, private sector debt growth, was going up at a faster rate in any given year than public sector debt growth. And there are rather few exceptions that occur around recessions, and I mark those in yellow on the charts. And those are pretty, few and far between. During recessions, the deficits would go up, bank lending would go down.
Now listen carefully to this point, because she explains the thing that changed in late 2022 that is basically causing the phenomenon we're seeing now with gold rising and Bitcoin rising as yields also rise.
And then we move past that. What you see in the chart on the right is that ever since the 2008 global financial crisis, and especially ever since in recent years, we've been in this period of time where federal debt growth is consistently going up at a faster rate than private sector debt growth. And I highlighted again in those little green boxes, if you can see them on the right, that even outside of recessions, this is still the case. So this was happening before the pandemic, and after the dust settled, after all the money printing, it's still happening now. And the reason this turning point really matters is because when we look at what the Fed, what their tool is to control credit growth, it's mainly interest rates. If they want to slow down the economy, slow down credit growth, and try to slow down inflation, they jack up interest rates to try to make borrowing less attractive. On the other hand, if they want to accelerate things, they tend to lower interest rates. The problem is that, many decades ago, when federal debt was low and most of the money creation was coming from private sector, whenever they raised interest rates, they would slow credit growth. They would slow the private sector faster than they would blow out fiscal deficits. The problem now is that now that they have over 100% of GDP, which only happened in recent years, when they raise interest rates, they ironically increase the federal deficit at a faster pace than they slow down private sector credit growth. Basically what that means is they don't have brakes anymore. The train, nothing stops this train because there's no brakes attached to it anymore.
So this is a very important point. What has changed recently is that the government debt is now over 100% of GDP, which basically means that they're running insolvent. Okay, so keep listening to this, because this is an important part of the big change.
Or another way of putting it is the brakes are heavily impaired. We've kind of gone through the looking glass. We're in Wonderland now, where the rules that worked for the majority of this time frame now work backwards. They don't really have a way to slow down total credit growth in the system. And that's a new phenomenon. So for the remainder of this talk, I'll just go over a few slides of why this is so unstoppable. Why can't just a couple people get together and figure this out? Why is this so entrenched?
So what's happening is, as they increase interest rates, they're actually increasing the amount of government debt. They're actually increasing. It's not slowing down the system anymore. It's feeding on itself, and it's causing the government to take out more debt in order to cover their interest repayments, because their interest repayments are now over 100% of GDP. So the only way for the American government to pay those interest rates is to take out more debt. So ironically, as you raise rates, you're increasing the amount of debt in the system that is being spurred on by, it's public debt, it's being spurred on by the US government, and that's a problem. So that debt is growing at a faster rate that then they're able to slow down private sector lending. The other thing that it does as well is there's a lot of cash in the private sector, and as those interest rates rise, that cash gets put into short-term money market funds, and as that money gets put into short-term money market funds, it collects a yield. The higher the interest rate, the higher the yield. So these funds are actually making more money, and then they can then go, that's money into the system. That money into the system, it's called financialization. That money actually is stimulative, and it creates inflation. So you've actually got a scenario now where raising interest rates is going to increase inflation rather than bring it down. So the Federal Reserve is kind of trapped because government spending, fiscal policy has taken over.
Why is it that I'm confident to say that nothing stops this fiscal train, even regardless of election outcomes? I was saying it before the election, I was saying it after the election, because it doesn't really matter, nothing stops it.
And this is an important point, because I've seen on social media lately a lot of people complaining about Albo this, Dutton that, Kamala this, Trump that. What everybody needs to understand from an investing point of view, not a morality point of view, not a popularity point of view, But from an investing point of view, is it no longer matters who is in power. It doesn't matter if Albo's in power, doesn't matter if Dutton's in power, doesn't matter if Trump's in power, doesn't matter if Kamala is in power. Nothing stops this train means that the trajectory is now unstoppable, and the investment decisions that we need to make need to be agnostic of who's in power. We shouldn't care who's in power, because each party is basically going to need to do the same things. In Australia, we speak about this superannuation change, and you'll see why in a minute. That's what needs to happen in Australia. And in Australia, that's possible. We can do that, and I'll explain why in a minute. But in America, they can't touch entitlements. But let's keep going. But that point is important. It doesn't matter who's in power. You're wrong to believe that if Liberal gets in, or if the other side gets in, that it's going to fix this mess, because this mess cannot be fixed. And I'll talk to you about Elon Musk stepping away from Doge and basically admitting that that the mess cannot be fixed. And we'll go through that at the end.
And so on this chart, we have, this is a pretty simple chart. The blue line is 10-year interest rates, 10-year Treasury interest rates. And the red line, we have debt to GDP, federal debt to GDP. And, back in the 1980s, you had very low debt levels and you had very high interest rates. And we've gone on this 4 to 5 year decade journey of ever higher debt levels. But it's been offset by this structurally declining interest rate. And what that means, for example, if you double your debt, but you cut your interest rates in half, your interest expense is still manageable. So for this whole 40-plus year period, interest expense was actually pretty manageable. But what happened is that eventually we hit zero. Just math kind of reasserted itself. And so now we're in an environment where the first time in decades, interest rates are not going structurally down anymore.
So this is another important point. This is the other key factor that occurred. Interest rates hit zero. From 1981, they were over 16%, and they've been coming down to zero in 2020. So what that meant is that the government could take out more and more debt, but their servicing costs kept coming down because the interest rates kept coming down. When the interest rate lower bound hit zero and stopped going down, because it can't go below, well, it did go minus in some countries, but it didn't happen in the US. When it hit zero and couldn't go down any further, as the interest rate starts to rise and the debt is now as high as it is, you can see in the red line, that means that every time the interest rates rise, the debt servicing costs are going to increase. And it's gotten to a point now where the debt servicing costs are over 100% of US tax receipts. That's a problem. So that's the other key thing that has happened that's made this system now need to turn around and change from what we've seen from 1981 to now. It's now going to flip and go the other way. And Lyn explains that.
And debt levels are still very, very high. They're the highest that they've ever been since the 1940s. And so interest expense is actually becoming a very meaningful part of the federal expense for the first time ever. And there's no easy way to get that under control. If they cut interest rates super low, then everybody wants to get into scarce assets. But if they keep interest rates high, they keep blowing out the federal deficit, because we're kind of, like I said, we're kind of in Wonderland now. And according to the Social Security Administration's own numbers, by about 2035, they're going to deplete that trust. And what that means in practice is that they're going to spend down this $3 trillion into the economy. That's as the baby boomer generation enters their retirement years, which they're already doing and they're going to continue to do. This is going to continue to roll over. And if you notice, this kind of hit a peak in the late 2010s. So 2017, 2018, it was kind of hitting its peak and kind of starting the very early process of rolling over. And that's when deficits decoupled from unemployment. And that's when the federal debt growth started to exceed private sector credit growth. A lot of this timing happened because at around the same time, interest rates stopped going down, and the baby boomer generation that funded a lot of this on the upside is now in drawdown mode. So this is getting spent into the economy via healthcare, via travel, via housing, basically everything that people have to spend money on. And so this is a background expenditure that's going to go back into the system over the course of the next 10 years. Now, sometimes that exact depletion date will get pushed forward or pushed back by 1 year, but this is mostly actuarial math. It's kind of inevitable. And importantly, these people vote. Young people protest, but then they forget to vote. This demographic actually votes, and right now, anything that touches the expenditure of this fund is the third rail of politics. Both major parties in the US have vowed basically not to touch Social Security over this time frame. And so this is pretty much set in stone, even in a very politicalized environment. It's one of the few things the parties basically agree on.
I'll skip past this point, but I will explain one thing. So this rise in Social Security, basically this is $3 trillion that US boomers, so this rise coincides with the rise in the baby boomer population reaching peak working age, peak productivity age. So the baby boom generation after World War II led to a big rise in birth rates. And as those boomers came into peak productivity years, they were contributing to their superannuation, so their Social Security trust in the US. And that reached $3 trillion. What that $3 trillion was able to do is finance US government debt, right? Now, demographics is a problem because now that the boomers are all retiring, they're not contributing to that Social Security, to those pension funds. They're now starting to draw those pension funds down. So as they draw those funds down, they're taking money that they lent the government out of the system, and the US government has to replace that money because their debt is still high. They have to replace that debt and have to roll that debt over. Now they need to find that from different places, and that is also putting upward pressure on interest rates. Now here's something that's interesting. Lyn goes on to say that in the USA, it doesn't matter if you're left, right, you cannot touch these entitlements. Because the politicians know that because it's political suicide to touch these entitlements. Why? Because in the USA, the people that vote are the boomers. Remember, it's not compulsory to vote. And the people that vote are the boomers. The millennials protest and cause a lot of ruckus on campus and this and that and whatever, but they don't vote. They don't vote in the numbers that the boomers vote in. So what we need to do is basically take money from these pension funds, because that's creating the US government to go broke. But that is politically unpalatable in the USA. Now, in Australia, and we spoke about this on the Unemployable Friday session, in Australia, it's much different because it's compulsory to vote. So you'll notice that recently Albo and Labor are putting in a new law where if you have super over 3 million, you're going to get taxed on unrealized gains. So basically what's happening is they're saying, shit, there's all this money in these pension funds. We need to collect some of that to kind of fund our deficits and our debt. Now, in Australia, these policies they're popular, right? Labor will stay in power for these policies, and you'll probably see Liberal do some similar policies. They will start to tax people because who are the people with all the assets? It's the boomers. Who are the people without the assets? It's the millennials. So it's a rational decision for the millennials to vote for policies that basically tax the rich, right? So we need to be careful with that with relation to property, with relation to shares, because they're the assets that are going to be sold down in Australian superannuation funds. 33% of superannuation funds are invested in international equities, 23% in Australian equities. I think it's like 12 or 18% in bonds. So these assets are going to be sold down because people are not going to want to pay the unrealized gains. So that's another reason why I think in Australia, gold and Bitcoin is going to outperform your superannuation or stocks and property, is because people are going to be forced to sell these assets to avoid the tax, right? At the moment, only 80,000 people are affected by that change. But in 40 years, the majority of the population is going to have a super balance above 3 million, right? And this is only the tip. This is only the tip of the policies that are going to start to come in to basically tax these long-term debt holders.
One of my last slides is to emphasize the Ponzi nature of the system. So even aside from current issues related to demographics and debt levels, basically the way the system is constructed, and by the system I mean central banking with fractional reserve banking built on top of it, the whole fiat system we've been kind of operating under for over a century, it relies on constant growth. It's like a shark that can't stop swimming, otherwise it drowns, ironically. It's a system that has to keep increasing. And so on this chart, the top line is total debt in the system, in the US system. So that's public debt and private debt combined, and it's actually over $100 trillion for the first time. And the bottom line is the monetary base. And what we see is that for the entire period of this chart, so this goes, I believe, from 1966 until 2025, the entire period of this chart, total debt never went down except for one very brief exception, and that was 2008. And it went down by about 1% total debt in the system. And what they did was they rapidly increased the monetary base from 1 trillion to right now about $6 trillion. It was so impossible for them to let even a tiny amount of deleveraging occur that they kept the party going. And specifically back in that time, so if we do the math a little bit, in 2008, the total debt in the system was in the ballpark of $50 trillion. So it's about half as big as it is now. And they were on a monetary base of about $1 trillion. So the system is levered 50 to 1. That's the type of leverage you see in like crypto degen derivatives contracts. It was like it was 50 to 1 leverage across the economy. And specifically, they hit 0 interest rates. So they couldn't keep propping up the private sector debt bubble. And instead, they rotated to the federal level. And so that kind of shows how sensitive the system is. As you've kind of gone forward, we're now more in the public sector debt growth. I actually looked at the data that goes back even longer than this chart, going back about 110 years. And there were only 4 other years where the total debt level ever went down nominally. And that was during the Great Depression. So 1930 through 1934 was the only other period beside 2008 on the chart where it went down. So 5 years out of over 110 years of data is their tolerance level for ever letting that Ponzi unravel. And that's just kind of the system, that's the math that we find ourselves operating in. And that's the big contrast that we have to Bitcoin. So for my last slide, we don't have to focus on the details here, but just by looking at the shape of these charts, these are century-long charts. And so my main point with these charts is we've actually seen this story before. We've gone through something like what we're going through now in the US one time in the past, and that was around the 1940s. So the reason that debt growth is so smooth historically is because when they do finally run into something that actually challenges it, they rotate the whole system around, and we're going through it for the second time. So basically, you have a private debt bubble build up, and then you hit 0 interest rates. So you can't keep adding more and more on to the accelerating private debt growth. And then what happens is you find yourself levered 50 to 1, and you start to unravel. And how do you unravel a system that's levered 50 to 1? The short answer is you don't. You just print more base units, is how they always handle it.
This is a super important point. So we've got interest rates, we've got demographics, we've got, so interest rates reaching their lower bound, 0. We've got demographics reaching their peak for boomers. And we have a debt Ponzi that has, listen carefully to what she said, it has only been allowed to deleverage. The amount of debt in the system has only been allowed to come down twice in the last 110 years, or 4 times in the last 110 years. The last 2 times were 2008 and 1930 to 34. So 1930 to 34 was the Great Depression, and 2008 was the Great Recession. The debt in the system in 2008 was only allowed to come down 1%. So if you have a $100 loan, right? If you have a bank loan with the bank and it's $100, you basically brought your debt down to $99. That was the extent of the deleveraging in 2008. Those 3 things, demographics, interest rates hitting 0, and in the last 100 years, the system has only been allowed to deleverage of debt twice. And the last time it happened, it only come down by 1%, tells you that nothing stops this train. Basically, you can see that no one in the Western world has the political incentive or the political appetite to go through the pain that's going to be required in order to bring the debt down. Because the truth of the matter is, everyone can talk a big game, but once they get in power and they see then they give it a go and they see the whites of the eyes of the problem, they realize, shit, this austerity, this bringing the debt down is going to cause a depression like we've never seen, because we've crossed the Rubicon and we've gone too far. So it's pointless us podcasters and you guys commenting in the comments at home to complain about our government or our system. They're actually quite brave for wanting to do this freaking job with the problems that they face, right? Like, let's give them some credit. The fact that they even want to do this job, that's an unwinnable job, is amazing. We should be supporting them, right? But what we need to focus on is understanding how, if we can't beat them, we need to join them, right? We need to take advantage of this system rather than complain about the way the system is. Because all you are going to see is they are going to try a controlled transfer of wealth from boomers to the young. That's what Bitcoin is. That's what the new technology is. It's a controlled transfer of wealth. They don't want it to happen rapidly, because if it happens rapidly, it'll cause a whole bunch of problems, but they want it to happen in a controlled, slow manner, right? And that's why you're seeing the US promote Bitcoin. That's why you're seeing the US take things like go and buy stocks, because in the US, they're more explicit. They're willing to say, hey, this is what we're doing, go and do it. Whereas in Australia, we're not so explicit. But we need to be tuned into the game that's being played, because this only comes around once every 100 years. And you look at the description of my channel, this is the largest wealth transfer in human history. It's the largest wealth transfer in our lifetime, and it's happening now. It hasn't happened in the last 100 years. It's happening now in the fourth turning, in what we call a fourth turning. If you haven't read that book, I'll throw it up, and I recommend you go read it. It was written in the 90s, and it's still prevalent today, the things that were discussed in that book. So 2 of the signposts that basically back up everything Lyn is saying, and they've just happened recently. I think he said it on CNN, yep. He said that we've inherited a 6.7% deficit to GDP, so Lyn was discussing that before, the highest outside war or recession, so we discussed that earlier. Our focus is to grow the economy faster than debt. That's how we'll stabilize debt to GDP. So this is basically an admission that we can't rein in the debt. It's not going to be possible because nothing stops this train. Our only option now is going to be to grow our GDP faster than the debt. So we need to outrun the debt. We need to grow quicker than the debt. What that basically means in layman's terms is positive for stocks, positive for property, positive for gold, and positive for Bitcoin. All right, positive for assets. Now, which asset grows fastest? That is something we can debate. Elon Musk came to the same conclusion. So the smartest man in the world, potentially the best entrepreneur that has ever lived, and has been able to create industry and make industry profitable, land rockets where no one else could, and make that profitable through first principles thinking, has basically come to the same conclusion that I've perhaps come to the obvious conclusion that accelerating GDP growth is essential. Doge has and will do great work to postpone the day of bankruptcy, but the government, the radical government spending, and nothing stops this train, basically means that only radical improvements in productivity can save our country. So it makes logical sense that the smartest man in the world goes back and works on a robot company, because we're not going to be raising productivity and GDP with humans, because we have a demographics problem. Our birth rates are already below replacement age in the Western world. So the only way that we're going to grow out of this is going to be through raising asset prices, right? And the government taking the tax on the back of rising asset prices. And it's going to be by speeding up humanoid robots and AI to basically increase productivity. The more robots we can put in the workforce, the more that we can increase productivity, the more that we can increase GDP, and then hopefully we can grow faster than the debt. That is the only possible solution, which means you must buy assets, not financial advice. Just some guy on the internet trying to make sense of what's happening and trying to give you the key signposts so you can do the same. We'll finish off with a couple of other slides that basically Luke Gromen is saying the same thing. You know, the gold is indifferent to what US policymakers now choose, because debt spiral or print, right? Gold wins either way. So back in 2022, when the Biden government and Secretary Yellen basically tried austerity, they tried to rein in the budget, long-term bond yields spiked, and in order for the government to finance themselves and their debt, they had to issue debt at the short end. When the market sees that, they realize that that is inflationary. Issuing debt at the short end is highly inflationary. It's putting money into the system, and that's when gold and Bitcoin started to rip. All right, and they will continue to rip while the government needs to continue to fund themselves from the front end, because that's basically increasing debt, and it's putting more money into money markets. It's giving a high interest rate, and it's putting money into the system that is usable, and it's not locked away for 10 years or 30 years in bonds. You can see the same chart that Lyn shared, and then this is gold versus treasuries. So treasuries versus gold. So treasuries are basically going to zero versus gold last 10 years. This is the market value of market value of US official gold as a percentage of foreign held US treasuries. So there was a period in the 70s and 80s when inflation was higher, and we're in a similar situation to we are now, where the percentage of gold on the balance sheet rose to 130%. We're only at 15%, so gold still has a lot of room to run. This is treasuries versus gold since 2014. So treasuries just continue to get slammed. So it doesn't matter, right? These superannuations, these pension funds, whether the government basically takes it from you, steals it from you with taxes, or whether gold and Bitcoin outperform treasuries, in one way or another, that money is going to get taken. So it's either going to get taken outright by taxes and confiscation, or gold and Bitcoin are going to rise against it. So that money in those superannuations, that money in the treasury, that money in those pension funds is going to melt. So if you're listening to this and you're at boomer age, you want to be taking your money out of your superannuation if it's invested 30, 40, 50, 60% in bonds, because on a real basis, you're going to get killed. Right? So you want to be taking that money out and putting it into gold, putting it into Bitcoin, self-managing it perhaps, maybe not in self-managed super if it's over 3 million, but if you leave it in your superannuation, it's probably going to get killed on a real basis over the next 5 to 10 years. So you need to look into these concepts much more, because superannuation is not going to be the safe thing that it has been over the last 40 years, that is for sure. And everyone is trying to tell you that right now. This is bonds versus Bitcoin. So a little bit more volatile, because when Bitcoin goes through bear markets, bonds become a better trade. But as you can see over time, trending down also. That's it, guys. That is, I hope that has helped to shed some light. I hope that has helped to explain the predicament that we are in. This is the most important topic in relation to our money and our time and our energy, our freedom, that I think exists at the moment, right? It's not all about making money. It's about surviving this thing that is unfolding. And, if you're watching this channel, then I think you want to do more than survive. You want to thrive during this time. And that's what I hope to keep bringing you week in, week out, strategies and ideas around how we can survive. So just to reiterate before we close, bonds are going to get killed. Cash is going to get killed on a real basis because the increase in debt, because the increase in base units. The US government is basically outright telling you, we have to grow faster than the debt, which means business will grow, GDP will grow, stocks will grow, property will grow, gold will grow, Bitcoin will grow. And based on what I'm seeing, based on the fact that the main asset within superannuation and pension funds is bonds and stocks, they're the things that are going to need to be stolen from or sold down, right? Quicker than anything else. So relatively speaking, because gold and Bitcoin isn't currently in superannuation funds, and relative to these other things, stocks, property, and bonds, it only has a small percentage of global wealth allocated to it. The most rational place for that money to go once it's sold down is into Bitcoin and into gold. So I think gold and Bitcoin at least for the next 5 years, because it's going to be at least 5 years before robots can come in and help this GDP issue. So for at least the next 5 years and perhaps even the next 10, I think gold and Bitcoin outperforms stocks, real estate, property, bonds, outperforms it all. And given that given that Bitcoin is growing its user base quicker than gold is growing its user base, you may see Bitcoin outperform gold. But not financial advice. You need to go out and work out how to best balance your portfolio. But this is what's happening, guys. This is why it's set up. This is why it can't be stopped. And this is why the road ahead is clear if you're willing to do the work and understand it. Anyway, guys, that's it. Hope you've enjoyed this episode of Money, Markets, and Mayhem. We'll see you next week on the next one. As always, if you're getting any value from it, share it in the comments, like, subscribe, and pass it on to your friends. Take it easy. Bye for now.